So let's just say for a moment that you were part of a tiny percent of the population that has an excellent credit score. For some reason, your credit score dropped to say good or average. Would you want to continue your life as usual, getting say a mortgage, auto loan, credit card, overdraft facility? Or would you first want to wait to get your credit score back to excellent where it was before? Is having an excellent credit score really all that good? Is this something that you should try your level best to achieve? In this video, I show you by the numbers the difference between having an excellent credit score and any other type of credit score. So if this is what you want to find out more about, watch this video until the end where I show you what I think is the best option for you. Hello and welcome to my channel. My name is Nyiko, financial advisor, also financial coach. On this channel, I talk all things personal finance and entrepreneurship. So if this is the type of content that you like to see, please smash that like button, subscribe, and hit that notification bell so that you can be notified every time a new video comes out. All right, let's get into it. Should you delay getting a mortgage to improve your credit score first? Pardon me, but this video is going to be quite involved, technical, and has a lot of moving parts. But I've tried my best to simplify it without diminishing the main points that I'm trying to get across. Okay, let's say your credit score was average. You desperately want to get a mortgage, even though you watched my video, your mortgage is a poverty trap. Or perhaps because you watched my video, your mortgage is a poverty trap, you want to get yourself an investment property. In this video, we're going to try to see if waiting to improve your credit score before getting a mortgage would actually be worth your while. This video is a continuation of my other video. This is what your credit score can get you. I got the numbers that we're going to use in this video today from myfico.com, and these numbers are correct at the time of recording this video. If you didn't watch the last video, please check it out so you can see where we got these numbers from. You will see what I mean here and now. Let's quickly recap from our previous video. We said we want to buy a house for $300,000. We want to live in it, so we're not going to put up a down payment. This being said, with the current repo rate, these are the type of interest rates you should be expecting to pay. Please note that these rates will vary based on the type of credit score that you have. Of course, in this example, we're not looking at affordability as well as any type of collateral that you may be putting up as security. Are you good with the numbers? Pause this video if you want to give the numbers a better look. Okay, scenario 1, average credit score. Do you know what your credit score is? If you do, please let me know in the comments. Of course, you don't have to let me know what your credit score is, but just that you know what it is. If you don't know what your credit score is, also, please let me know in the comments. With an average credit score, your total monthly payment will be $1,450. This would be an increase of $262 per month compared to having an excellent credit score. What if you delayed getting a mortgage by 12 months? You were willing to pay $1,450 per month, so let's keep that monthly amount. What if you were to spend this 12 months putting away this $262 per month into some kind of savings account? You would also use this time to pay down some of your credit facilities, as well as making use of other tips that I provided you with in my credit score playlist so that you can improve your credit score up from average to excellent. Remember, even though we're only going to apply for the mortgage in 12 months time, we have already started to buy your house. We will assume for this example that your rent amount is the same amount as what your mortgage amount would have been if you would have had an excellent credit score. So that would be $1,118 per month. Within 12 months, from putting away this $262 per month, you would have raised $3,144. Of course, this is assuming an ordinary bank account with zero interest growth. 12 months goes by and congratulations, your credit score has improved from average to excellent. So you bring your savings of $3,144 and put it up as a down payment. Great stuff. Now the lender will only charge you an interest rate of 2.516% versus 4.105%. You had to delay getting your mortgage by 12 months, but you're in less debt in general. Furthermore, you are paying a lower interest rate on your mortgage. So all things considered, you're a lot more comfortable. If you had gotten this credit score 12 months ago, when your credit score was still average, you would not have had to pay a down payment, but you would also not be able to make extra payments towards the mortgage. Your total payments at the end of the mortgage term would then amount to $522,168. Changing your credit score from average to excellent reduces your monthly payment from $1,450 a month to $1,118 a month. Again, this is a monthly saving of $262 per month. Let's say you take your monthly saving of $262 a month and add it to your monthly payment, thus paying $1,450 anyway. In this case, your total repayment at the end of the mortgage term will be $392,548. This of course would be your total mortgage repayment, factoring in your extra payments as well as your down payment at the beginning of the term. If you chose not to make the extra payments, your total repayment amount would be $426,291. This being said, from making interest payments alone, you would save $33,743. Thus, your total repayments, if you had an average credit score, would have been $524,000. If you had saved up for a down payment while renting for 12 months, your total repayment would be $426,291. If you had saved up towards a down payment while choosing to rent for 12 months instead, and also made extra payments towards your mortgage by paying the same amount that you would have had to pay if your credit score was average. Lastly, if you had chosen to put up a down payment as well as make extra payments towards your mortgage, your total repayment amount would be $392,548. Scenario 2, excellent credit score. If you haven't already, please smash that like button, subscribe, and hit that notification bell so that you can be notified every time a new video comes out. By waiting to clean up your credit score first, you created for yourself the opportunity to be able to raise a down payment, but also to be able to make extra payments without changing how much you would have been contributing towards your mortgage on a monthly basis. In so doing, you also saved yourself $129,619. To put this into perspective, this is a saving of $130,000 based off financing a $300,000 asset. This would have been the kind of money you would have had to spend had you not been willing to wait for 12 months and improve your credit rating first. This is a huge saving, and the savings don't even end there. You would have also reduced your loan or mortgage repayment period down from 30 years to 22 years and 7 months. I have not forgotten that in choosing this option, you continue to rent for 12 months, throwing money down the drain for 12 whole months. If you're a regular on this channel, you already know how I feel about the rent versus buy argument. If it's your first time on this channel, please check out my rent or buy, which is the better way to build wealth video. To be fair, by implementing everything that we spoke about in scenario 1, we were able to generate a saving of $129,619. We have not, however, accounted for the 12 months of rent that we spent while we were waiting to improve your credit score. This, generally speaking, is unlikely, but let's assume that you were paying in rental the same amount that you would have paid for a bond with, say, an excellent credit score. This would mean that your monthly rental amount would be $1,118, totaling to an annual amount of $14,256. So then, looking at your total savings across the entire mortgage term, this time factoring in the fact that you lost money for 12 months due to the fact that you rented, your total saving is $115,300. $363. Considering once more that the actual item that you were trying to finance cost $300,000, that is a mighty saving. Scenario 3, what if you had invested the money instead? If you haven't already, please smash that like button for the YouTube algorithm. It would really help my channel and I would really appreciate it, which would help me to continue delivering to the best of my ability value to this channel. Let's put this on steroids, why don't we? Instead of using this extra $262 per month to invest into the mortgage, let's say we invested this into an asset that yielded, say, 9% per annum. Because you're no longer making extra payments towards your mortgage repayment term goes back from 22 years and 7 months back to the full 30-year term. Assuming that you kept your contributions flat, in other words, kept your contributions towards this investment at $262 per month throughout the entire 30-year term, this is the number that you would have at the end of the term. You would have $428,550 at the end of your 30-year term. Yes, you would now forego the $115,363 in interest savings on your bond. Yes, this is understood, but by choosing to invest instead, you would still be up $313,187. You would also own your property free and clear. Please do bear in mind that the $115,000 saving is based on having an average credit score. If you were to improve your credit score and also invest, these numbers would be better still. To those who are regulars on my channel, please note that this method is still using the income that is earned from the sweat of your brow to build wealth. In this scenario, you are not making use of leverage in the direct sense through your credit facility, but instead through the credit facilities and the scalability of the underlying companies that you would have been investing into. If you don't know what I'm going on about and you haven't already, please check out my video, Your Mortgage is a Poverty Trap. Please note that in this example, there is quite a big difference between the investment return that you can hope to achieve from investing your money in the stock market versus the prime lending rate that your bank can offer you. This being said, for most countries, if your credit score is excellent, there should be a number of investments that should yield a higher return than the prime lending rate. If you live in such a country, it is therefore far more prudential that your credit score be excellent. So, would you wait for 6 months, 12 months, 2 years to first improve your credit score before getting your mortgage? I know I would. Of course, this is assuming that I would get a mortgage on a property that I actually live in. Not saying I wouldn't, but if I did, it would be down to the numbers. I would be able to justify it by the numbers, not feelings. For my money though, I would, to the best of my ability, try to make use of leverage. This is thoroughly explained in my video, Your Mortgage is a Poverty Trap. So for the last time, if you haven't already, please check out that video. Also be sure to check out my credit score management playlist. If you've been watching till this far, I can't tell you how much this means to me. Thank you, thank you, thank you. If you haven't already, please smash that like button, subscribe, and hit that notification bell so that you can be notified every time a new video comes out. Thank you so much for the support. See you in the next video. Cheers. So I've been running my financial planning practice for about 8 years now. So I've been thoroughly exposed to all the methods that work and all the methods that don't work. And as an extension of this YouTube channel, I've also now started to consult one-on-one, helping you with wealth coaching. We talk everything from credit, how to speak to your banks, buying cars, property investment, everything you need to know so that you can achieve financial freedom successfully. If you want to get in touch and schedule a consultation, contact me via the email provided in the description.